Hello traders, this is FreeFX. I'm Francesco, and welcome to my video. Today it's Friday the 12th of August. It's actually just the 13th now. We've just gone over the midnight point, and it's been an interesting week. We've had a lot of movement in the S&P500, or SPX in this case, and we just really had a lot of commentary about this on Twitter. So if you follow me on the account, you'll see my posts, FreeFX10, and obviously been looking at other people's ideas about this, different comparisons to various kind of previous markets or various stocks, and various opinions about how the Fed is positioning itself versus the markets. General kind of perception of what this is. Is this a bear market rally, or is it really, have we bottomed and in June we started the new trend up? So I thought I'd start the conversation with, as always, a technical outlook from the monthly down to the kind of lower time frames, and decided to just focus on the SPX rather than going to futures, etc., because there's not really much I can gather from that as well, because the charts are limited to recent periods, so I can't go back much further. So the monthly, as you can see, just to begin the conversation, is quite bullish at the moment. We've had 2 months now, or rather 1.5 months so far, to the upside. So if you can imagine this as kind of objectively looking at something, you might say, well, if I were to buy here, fine. If I were to buy here in the second month of this sort of green run, I would still be entitled to buy, except we've come up to this. So why is this line significant? Well, it's just, for me at least, a line in the sand, because it's the 21 weighted moving average, and it's what I use for setting targets on kind of normal trading conditions and contexts, through using that in combination with the basis, which is a 20 SMA for the Bollinger Bands. I've purposefully kind of got rid of the Bollinger Bands right now because I'm going to do something else on this chart. So, but that's why that's sitting there, and the level that it's at is currently what this black line represents. So the 21 weighted moving average is just above the market at the moment. You'll see that we're not quite at it because the monthly obviously compresses things quite a bit. What's interesting about the monthly as well is obviously the CCI. So if you were to use it as a filter, you can see that from 2008, the Great Financial Crisis, we have not had many occasions where the CCI on the monthly has edged below the middle or neutral line. So here's the 2011, then followed by the 2015-16, then we've had the 18 and 19, and then we've had the COVID 20, as well as the current move down. So altogether 6, but not all the same, not all created equal, because you can see that the current one is more like the one previous, of the 2018. And if you look at what happened in 2018, we had essentially not a very long run, something like 3 months down, and then straight up from there, although it sort of struggled a bit. But just to say that our shorts at that point might have struggled, and we've had 6 months now, so it could be a bottom. And you'd have to go and sort of read all the news about 2018, what happened then. You'd have to go and read all the news and sort of see what the perception was, what kind of data was coming out, etc., to really make a comparison that holds in terms of sentiment. But like for like, well, you could say that we've overstayed our welcome in bearish territory, and we sort of claim that we've overcome that. Another one that you see is obviously the one here in 2011, 10-11, and you can see that it's maybe more like what we have, because the number of red candles does exceed just 3, as we've seen in the one in 2018. So we've got a total of 5 consecutive down months, and then a recovery after that. So we've had 6, so it could be similar to this as well. It's not a straight recovery, and the months are slightly different because September there as the final one, and we obviously we had June as the final one. So it, similar, but obviously months are different, and that means volatility is different. I'm just going to leave the 2008 one there for a second because on the monthly is obviously very good, but I'm going to kind of scale down. So let me go to the weekly and show you this. So on the weekly, we have, so the chart is logarithmic, so it gives more weight to percentage based moves, or rather, it's not so much the price, but it's the percentage change that makes the, so it's not even. So you can see that the gaps here in price are a little bit more compressed where changes are smaller. That's how I understand logarithmic anyway. There are different ways of explaining it, but that's kind of how I understand it. And so the importance of that is it makes bigger moves bigger in terms of space rather than just going by price. So it gives them more emphasis, as they should be, relative to where price was. So it makes, if it's a $10 move where the market's going to be moving like $1 at a time, that's a huge change, although it's just $10. So, and that's kind of what algorithmic charts can help you do, and they're especially used for longer term charts where this kind of thing is important, but it's also useful to have them on shorter term charts. But anyway, let's kind of delve into that another time perhaps. But the weekly here is interesting because you can see from here that we have something. I'm just going to do this. Then if I just give you a look at this parallel channel, and the parallel channel is important because I just wanted to show you this. 1 second. Now, from there you can see that essentially we don't have a lot to go by. In the sense that we're at the top of this parallel channel, or let's call it a trend line. Okay, so there's a downtrend, and we've had one touch of this sort of sloping trend line, which obviously wouldn't start from here because we don't know it's a trend yet until we get to this point and then sort of join these two. So the second point is now this one. You also see kind of when you draw a parallel channel to parallel trend lines, you get this sort of middle line, which is the reversion line. So that's the middle line, if you like. And we tend to sort of gravitate around that, and we sort of gone beyond and past it and gone to the other side again. So that may be a sign that again the bear trend is overdone. Because you might have expected this to bounce below, but that's not always the case. And these bear markets can last any number of months. It's not to say that it has to last like the previous one of this magnitude was 2008. But so we're at the top. So now we have a confluence of two things. We have the monthly time frame weighted moving average and this trend line. The only thing is that you have to be quite strict about these things. So technically speaking, this trend line is joining the, as you can see that, I'll make it a bit bigger. This bit here is the top of the high, and then you've got the top of the high there as well. And now it's actually the top of the close so far, because the high is also the close. This is kind of a solid candle. So you'd have to wait until the end of the month, really. But so that's kind of where we are at the moment. That's where the line naturally ends up. It's not like I've made it to join these. It's just it ends up there. So, so two things have actually kind of coincided. And another thing as well, which I need to go into, but that's going to be on the daily. So on the daily, and I haven't talked about the CCI there particularly, but that's because I want to move on to the daily side of that. So on the daily now, we also have another thing which is very important, which is the 200-day moving average. I call it 200-day because it's a daily chart. Otherwise, I had to refer to it as the 200 week or whatever. But it's the 200 period in a daily is a 200-day. And as you probably know or have heard of, many people say that this is the preferred measure of position or trend development used by fund managers or institutions or whatever. And I don't know for sure, but certainly it's been talked about a lot in that respect. So I think there's probably some truth in that. And it's a great way to summarize a trend sort of visually. You can see that's very good at showing you where we are. So clearly we entered. It's lagging. Obviously, it's massively lagging. So this downtrend in January. We crossed below that. And of course, you can do a crossover between different moving average. So if I sort of kept the weighted moving average there, you can see that the moving average crossed below the 200-day moving average here in February, although price actually crossed below the 200-day moving average in January. So usually the moving average crossover technique is fairly good if you've got a fast moving average crossing above or below. That usually works pretty well. But in this case, actually, it was slower than price itself. So what I was going to say was the 200-day moving average is coming up just above the monthly 21 weighted moving average level. Okay, so that means that we have a confluence of three things: the monthly moving average, the weekly trend line, and also the 200-day moving average on the daily. So three things above price. And of course, what we don't have in this kind of SPX is true volume. So we don't have a histogram showing volume, and we don't have any sort of aggregate or order flow, depth of market. We don't have any of that. So we're literally just looking at candles essentially, and previous price and continuation of that through time. One thing that we haven't talked about, which might be of interest, and I'm just going to maybe delete the 200-day moving average just to give myself a bit of leeway with the free version of TradingView, is the Fibonacci retracements. So if I just did that for a moment, and we're looking at the retracement not of the pandemic low to high. First of all, the actual high to low, the cyclical high to low from this top here in December. So I'm just going to do that, except we've never actually done it on this. So I'm just giving a second and be able to find out exactly where it is. Fibonacci, Fibonacci channel, I think it's here. Speed, resistance, circles, spiral, resistance, retracement. There we go. Okay, so let me put it here and then to the bottom there. So that's, I think I've got it just right back here. Okay, so we've retraced, just make it a little bit so that we are in the right place. So we've retraced up to the 0.23 in June, and July we've retraced up to the 0.38, and now we're heading for the 0.50. Okay, so essentially we're halfway. That's kind of as plainly as I can put it. We are, in fact, we are past halfway, beg your pardon. We're heading for the 0.61. I could probably change this to make it a little bit more darker, possible. Coordinate style. Here we go, style. If I can maybe just make these levels line darker. There we go. I think that's probably good compromise. Okay. So yeah, the 0.5, so which is an artificial fib level, is here, and we've just kind of gone beyond that. So we've retraced more than half of that move. If we wanted to change this in another way, that might be handy. Let me see if I can just squeeze that a little bit more. Okay, so I'm going to take this, and actually I'm going to delete it because it's probably easier to delete it. And I'm going to take this and check something else, which is the Fibonacci retracement of the low to high from the pandemic low all the way to the high just before the downturn. Okay, and I'll just extend that to envelope, if you like, current price. So based on that, if I've done it correctly, because you always have to check a little bit these things, we have essentially the levels are a bit mismatched. So it might be that I've done it slightly wrong, or it's maybe too long a period to really be of meaning. So what I might do is just expand a little bit and see better. Anyway, so that's a bit tricky because it doesn't really seem to want to have a squeeze that a little bit. Just trying to see if I got this right. Okay, and it just gives you extensions, so I might just have to delete that. Right, I think my fib experiment has not really amounted to too much, except maybe the one that I showed you before. And that takes me to another issue, which is the CCI. So let me just bring that up a little bit more, and you can see the CCI a bit better there. So let me just kind of, I mean, I've talked about this before, and I've obviously, I showed you before what I was thinking about. And if I just bring up the object tree, let me just move it up again, and unhide the circles, 1, 2, and 3, and also 1, 2, and 3. All right, okay. These seem a bit mismatched, to be fair, but I might be able to adjust them. So I think they adjust as you move things a little bit, perhaps. Okay. All right, that shouldn't have happened, but it has, so not to worry. Let me just put it back to where it was. 1, 2, and 3. All right, so what am I showing you here? If you haven't seen this before, essentially, I'm trying to show you one thing that's very, very, very simple. It's just kind of my idea of how this might work based on something that John Bollinger said about CCI, not CCI, sorry, about Bollinger Bands and bandwidth. I'm putting it on the CCI. So you can see three highs, and then the CCI equivalent, and the CCI showing kind of slowing down there, and then a deep divergence from there. So if you can't see that, I'm just going to use a brush and do this. So from this point, okay, which is July, 29th of July, there's basically that. Okay. And that's the point, and then this point down is here. Okay. Now, what's interesting is we have this change today, and this is quite remarkable because it's kind of being dragged up, and that's the consideration that one should bear in mind. We've had a divergence before here, and this is sort of the bigger one, if you like. But you can see the divergence even better if I went down. Let me show you on the 4 hour. Okay, that should come up in a second. So that's what I just drawn there. If I get rid of that, and also this one, just need to have a select tool on, actually, it'll be easier. Thank you. And that one, and that one. That really gives you a better idea of what I was trying to do. I just got rid of something by mistake. I think it's okay. Just something silly. I've lost something. Never mind. I'll be able to restore chart. Let me see if I can restore reset chart. Right, I think I've lost it. So what I'm going to do is I'm going to maybe load the layout. See if it's still there. Okay, that's fine. So where are we? Okay, back to the 4 hour then. 4 hour is here, and so the 4 hour is, as I said before, is made of lots of small divergences, which I've highlighted in previous videos. And in this video, I'm going to actually sort of sum it up, because now we've got quite a bit of data from the last few weeks and months, and it might be handy to do that just now. So let me just save this in case something happens. And so the divergences that I'm interested in are obviously from, let's see, yeah, from the bottom here of the June, the final kind of push down. We've got essentially one divergence happening here from this peak, 24th of June. Then we've got one divergence happening here in July, 7th of July, and then move down. Then we've got a divergence here with lower highs in 19th of July and continuing until a small turn down. So from this point on, you can see these sort of small divergences, 1, 2, 3, and 4, kind of 4 in a row, which is a bit extreme, I think, if you imagine you know, a natural flow of a trend. It is a little bit extreme in a way, but that's kind of what happens sometimes as well. So you have to really go back and check lots of instances of that. So part of me thinks, you know, is this an actual uptrend? Because in a trend, a true trend, you will register a lot of this kind of pushing up or down towards, as you can see here on this downtrend from January. Sorry, that was April, actually, this bit here. This year we had almost 1, 2, 3, 4, 5, at least sort of 5 touches of the or aiming towards the negative 200 on CCI, which is kind of like an extreme, but it's a 4 hour, remember, so it's good for trending, but it's not oversold necessarily. And now we've got these sort of 1, 2, 3, 4, 1, 2, 3, 4, almost 5 or 6 touches on the upside, and you know, the trend is continuing by the sounds of it. So we kind of had to be careful. I say we, meaning me. I have to be careful because I'm still short. I've been short for a few days and weeks, and I'm not sure at this point what's happening, if it's a short squeeze and it will eventually actually move back another leg. And that's the $1 million question. The $1 million question: is the market done with this rally or not? So of course we don't know the answer to that. One thing I would say though is I'm going to just delete the CCI, because I saved this obviously so I can reintroduce it, but the important thing is to have a measure of actualized volatility. So I just use the ATR, and there's sort of lots of debate as to you know, one thing that was being said, I think it was John Bollinger on Twitter, was that the ATR or volatility tends to be lower, obviously, on an up move. I'm not sure if he was talking about, say, options volatility, or so implied volatility or actualized volatility, because this, you know, the ATR is a trading range, is based on movement, and I think it's a little bit less clear without statistics in hand how much that may be true. But that being said, if I just change that to my usual settings, which is 21, which is the same that I use for all my other, and instead of the RMA, which I explained in my last video, I'm going to try and use maybe the SMA. There we go. So at the end of all that, what you see here is that the ATR has been dropping consistently, and actually that becomes really, really clear on the daily chart. Let's give you the daily chart there. Okay. So now you might be forgiven for sort of immediately saying and kind of screaming at the screen that this chart here is reminiscent of the VIX, okay? Because the VIX is also at extreme lows, and if I introduce that compared with the VIX, let me put a VIX here, so VIX, and VIX volatility, S&P 500, new price scale, and here it is. Okay, so if I were to hide the Bollinger Bands, just to make it a little bit clearer, hide the moving average, there we go. So there's the VIX there, okay? And if you look at the VIX, it's, not really, when the VIX is elevated, the ATR is not necessarily elevated. And we had an increase in ATR. It's not always a case of the ATR rises on a bearish, because we've got a rising ATR sometimes that actually deals with, like, in this case we've got a rising ATR and the market is moving up, or rising ATR, the market is moving up. So it's not always the case. And in fact, I think the ATR and the VIX are not sort of bedfellows, so to speak. But in this actual instance, they are. If you look from June, the VIX has been just falling and falling and falling, and the ATR has been falling. In fact, this level on the ATR is the same level. Let me just put a line to that horizontal line. That'd be good. Horizontal line to here. Okay, that's kind of where we are now. And that level, as you can see, is approximately the same as middle of April, and it was the highest level back here in October. Okay. So if you wanted to just be very, very clever, which I'm not going to try to, and I just reduce the VIX there. Okay. So what happened in? Let me just kind of put a rough circle here. Study these things. It's important to have a reference point there, and a circle here, and then one where we're at now. See, so let's study these kind of 3 points in time where the ATR was around the level that it's at now, which is 71. Okay, so the average true range on the daily for the SPX at 70. Let's call it 70. Okay, so in terms of this one, okay, so let's follow the center of this and put a vertical line, perhaps. A vertical line. I'm just going to put it kind of here, and in the middle of that. Okay, and then I'm going to put another vertical line here, in the middle of that, and then one for now, obviously, because that's where we are at the moment. So put it there. All right. So what happens in these 3 periods? We've got October of last year, April of this year, and August. Not quite equally spaced out, but nevertheless. Now we did come back to these levels around here. So let's put that will kind of make it evenly spread out, I suppose. So let's put a level here, kind of roughly at similar levels. So, right, is there anything that's similar to these 4 instances of an ATR around these levels? Okay. Is there or not? And that's what we're here to discuss. So if I just kind of look at these visually, the first thing you'll notice that the VIX, okay, the levels of the VIX. So I'm going to put another horizontal line, okay, and the horizontal line, so I'll just maybe hide this so it's a little bit easier to see what's going on. So I hope the chat is going to get a bit busier now. So what I'll do is I'll maybe just make this a little different color. Let me just go into the settings and make it, VIX is going to be a violet color. That's slightly dark. There we go. Right. So here's the VIX in a slightly different color now. And what I'm going to look for is some kind of connection between these four events. And I'm going to use a horizontal line again, a horizontal line from the current level, which is here, the VIX. That's my horizontal line, right? So we're here currently, very low ATR, very low VIX, VIX, which is the 30-day implied volatility based on the underlying asset, which is the S&P 500. So the options volatility, 30-day. And so low VIX means obviously expectation of low implied volatility, so low risk of a downturn essentially. But let's not simplify things overly. But let's kind of look at this again. The next touchdown, if you like, on this level was back here in end of March. Okay, and the ATR was kind of coming down, but the VIX was much lower than the ATR. The ATR would take quite a bit longer to get down to these levels, in fact. So it was the here, 19th of April, as I said. So essentially, well, about 3 weeks after the VIX. Okay. And then before that, we have this point here, which was in January of this year, and then it started rising. Okay, and the ATR started picking up as well. So the ATR is lagging compared to the VIX, which obviously makes me wonder, should I use the VIX as an indicator? But I think the ATR is obviously better for trading targets than the VIX. But in terms of momentum or sentiment, really, it's usually been the VIX as a kind of market measure. And the final one here at this level, when this level of ATR was actually the top. Okay, so now we come from October of last year. It's almost been a year since we've actually been above that level, that 70 level, and we're coming back towards, and now we're going to go lower, or it's going to start rising again. If it starts rising again, so think of this level 70, essentially the bottom line is that this level 70 is kind of a support line for the ATR, which means that it's almost coincidentally a support level for the VIX. Well, obviously the VIX uses different numbers. For the VIX, we're looking at 20. So 20 for the VIX and 70 for the ATR are the values to look out for based on this analysis. And so all that considered, remember what we said about the resistance that the SPX price is coming up towards, and remember as well that these are extremes which are due for a correction. How long that will take, it's not maybe an hour or a day, as others might say. Of course, it's a matter of trading to your preferred kind of comfort zone in terms of risk. But that's really the end of my very long video. So I'm still without video because I'm still on holiday. So I'll be back next week for my usual on-camera videos. So it's going to be a very interesting week next week. I haven't talked about events, but obviously the biggest data we've had already is CPI, PPI, consumer sentiment survey. We've had lots of Fed speakers on tap. So there's, we've had GDP. There's not really much that we can expect in the following week. In fact, it's going to be a quiet week probably from that point of view. But I would say, keep an eye on things, because as volatility returns, perhaps later in August, with more liquidity. I think this is a very thin market, if you like. The volume, as I showed you before, on the futures is kind of getting lower and lower, so the VIX is extremely depressed, and I think we're due for some kind of pickup. So keep your eyes sharp and your senses smart, and have a great weekend. I'll see you next week for my next video. Thanks for watching. Take care. Like, share, and subscribe. Bye.